Hi, I'm Geoff Dohrmann, Chairman and CEO of Institutional Real Estate Inc., and welcome to IREI Live Multifamily. Glad you're all here. You should know that this is a sponsor underwritten event as opposed to our editorial advisory board meetings, VIP sessions, or our virtual roundtables, where access to the podium is never for sale. Here, the sponsors are the ones who underwrite the program, develop the content, and select and appoint the speakers. Although John Hunt, our program manager, always helps shape the agenda and prep the panelists to ensure these programs live up to the IREI standards for producing these kind of events. We're real pleased to note that we have more than 300 people signed up to view today's program. We expect about half will view it live and about half will view a recorded version later, and most likely will share those recordings with others in their firm. So this is going to create a lot of exposure for the participants in the content, as well as hopefully stimulate some great dialogue and create some insights for all of us. So first, let me acknowledge and thank our sponsors, since they're the ones who ultimately are underwriting and making these kinds of programs possible. Our sponsors for this program are AEW Capital Management, LP, Center Square Investment Holdings, Pro Holdings, FCP, Lionstone, and Multi-Green Properties. Thank you all. I'd also like to thank Lucera and her team, most notably John Hunt, for handling the many issues that need to be addressed in order to produce one of these events according to our standards. As you know, today's IREI Live program is focused on multifamily, and there's so many issues to talk about. First and foremost is just where multifamily sits now on the radar screens of most institutional investors. You know, when we first started Institutional Real Estate Inc. and started publishing the first institutional real estate letter, because it used to be a newsletter, we had one of the leading consultants of the time quoted as saying that she wasn't sure that multifamily really was an institutional quality asset. And there were a lot of investors who basically in their investment policies had excluded anything with beds in it, hotels, multifamily, anything like that. So obviously a lot has changed. And over time, the formats that people would invest in have also morphed a lot, you know, from traditional high-rise CBD versus suburban garden style versus senior housing versus student housing versus affordable versus workforce. So lots of different ways in which you can participate in this sector. And we've gone through a really long run since the GFC, of well over 11, 12 years since everything fell apart. And over that time, I think for every year, people have been raising the question, is the sector getting overbuilt? Is there too much multifamily being delivered to the market? And so far, well, we'll let the panelists discuss and get into that discussion. But if they are overbuilt, most people want to know which sectors and which property types and which markets. And if not, how come? You know, why hasn't all the money that's been plowed into the sector overwhelmed the sector? And why has the demographic story here held up so well for so long? There are other issues that are really being impacted by post-COVID, both collections and how those have held up during this period of time, and which kinds of properties have held up better than others in terms of collections, as well as emerging post-COVID, you know, well buildings and the role of technology, because there's been a lot happening on the PropTech front to help improve the ability to control information flows and also serve tenant interest. And a lot of that is focused on the multifamily sector. And despite all of the concerns that people might have, everybody wants to know which markets and formats really going to offer the best prospects from a return standpoint moving forward. And so what people want to know is what's the perspective from a research as well as an investment professional's perspective, and plus what's the investor perspective on the sector? Are they still as bullish as they were before? So there's a tremendous amount to talk about here. And with that having been said, let's get started. So let me turn it over to Chase McWhorter, our Managing Director for the Americas, who will introduce his panelists and explain how you as audience members can participate in the discussion by posing questions or challenging the panelists. Chase, it's all yours.
Thanks, Geoff. And as Geoff said, my name is Chase McWhorter, Managing Director of IREI's Americas platform. Before introducing the panelists and getting started, I just want to provide some background for context as we're going to go through this. So we're scheduled for 3 sessions. We're going to start part 1 it's defining opportunity sets, gateway urban markets versus suburban secondary markets. And then part 2, defining opportunity sets. We're going to do a deep dive into suburban secondary markets. And then finally wrapping up with the future of multifamily and talking about technology and sustainability across these different markets. We're going to basically go through the first 2 sessions without a break. So we're scheduled overall for 2 hours, 45 minutes. We'll take a break after the first 2 sessions and then come back and finish with session 3. Like Jeff said, this is meant to be interactive. We've talked with the panelists. We want them to ask questions of each other. We want to feed off of that. And then obviously you, the audience, we want you guys to interact too when appropriate. So with that, I'll bring in the panelists for part 1. And then I will let them introduce themselves, provide some background, and then we'll jump into the discussion. So thank you everybody for joining. We have Mike Acton, Jeremy Goldberg, and Dodge Carter. And again, I'll let them introduce themselves and their organization and just some background on what they're doing in multifamily. So we'll start with you, Mike.
Great, thanks, Chase. I'm Mike Acton. I'm the head of research for AEW Capital Management in the U.S. I joined the firm in 1990, and I serve on our management committee, investment committee, risk management committee, and things like that.
Perfect. And Dodge?
Good afternoon or good morning, depending on your location. Everyone, my name is Dodge Carter, and I'm with Crow Holdings. We're a privately owned Dallas-based real estate investment and development firm with a 70-year operating history and about $21 billion of assets under management. Over the past 40 years or so, Crow Holdings operating companies have developed or acquired more than 1,000 multifamily communities, which represent more than 300,000 units. Crow Holding Capital, in turn, is the real estate investment management platform of Crow Holdings and focuses on domestic investment, primarily in multifamily, which includes student housing and manufactured housing, industrial, food and service retail, and convenience and gas. Lastly, currently Crow Holdings Capital manages about $12 billion in real estate assets.
Perfect. Thank you, Dodge. And Jeremy.
Thanks, Chase. My name is Jeremy Goldberg. I'm with Stepstone Real Estate, where I cover large and small cap vehicles, which includes multifamily as well as diversified funds. Prior to Stepstone, I worked with Cortland Partners, who Stepstone acquired to really build out the U.S. real estate advisory business. And prior to that, I worked for a publicly traded apartment REIT, Associated States, which was sold to Brookfield in their opportunity fund. So I've been in and around multifamily my whole career.
Perfect. Thank you. So jumping right into the questions, and again, for the audience, again, this is designed to be interactive. So as we're going through, think of questions challenging our panelists. So Mike, we're going to start with you. And again, just for, I think, context, this might help shape kind of the discussion. As far as part 1, we're going to be talking about gateway versus suburban secondary. And then we're going to deep dive more into suburban secondary, but this group's going to kind of more talk about kind of both gateway markets, secondary, kind of laying a foundation for digging a little bit deeper. So starting with you, Mike, could you just share again your view kind of broadly on the gateway urban markets and how you're comparing it right now to secondary suburban?
Sure. I mean, obviously the gateway markets are big, deep, liquid. There's all kinds of micro locations within them that can work well for multifamily investments. They're very close to transit centers and employment nodes and things like that. All things that seemed really very great things to be near before we had a pandemic, of course, and the pandemic's been a big disruption to a lot of that. But the secondary markets in the U.S. Have a lot of growth going on. And that can be a great driver for cash flow, for returns, and so on. We're in sort of an interesting environment right now in the U.S. where pricing is largely normalizing across all locations for multifamily. Yields are getting squeezed to about the same level pretty much everywhere. AEW historically has been very active in all segments of residential. But in the past year and a half, 2 years, what we've really leaned into is the segment of rental housing, multifamily housing, that is affordable to people with lower to moderate incomes, maybe 50 to 80% of area median income. And what strikes us about this market segment, and it's been true for a very long time, is that the stock is not sufficient for the demand. These units stay 100% occupied pretty much all the time. If you are a renter and you are fortunate enough to have an affordable unit, a unit that's affordable to the income that you earn, you don't give it up easily, right? Where are you going to move in the same neighborhood? So if you need to be on a certain bus route to get to work, you need to be near a certain elementary school for your kid, you need to be near a certain senior living center for your parents, you're not going to give up that unit real easily. So the turnover is very low. The rent gets paid. That's been our experience right through this whole pandemic cycle, much better than the urban high rise. And so we're really leaning hard into that part of the market today. And for the country as a whole, I mean, it's sort of a vital issue. We're missing 7 or 8 million housing units in this space. And let's face it, most of the capital that's on this call, when they go into this space, they go in to take units out, not to put new units into the stock.
Mm-hmm. Well, and jumping to you, Jeremy. So kind of staying on the gateway markets. I mean, obviously, I think the headlines, everything's struggling with COVID. I mean, kind of looking at it from that lens. I mean, I guess one is it kind of overblown, the issues with the gateway? And then also, I mean, do you look, and I guess just to get your general view as well, I mean, post-COVID, what you're looking for, what trends you're trying to see? I mean, looking at post-Labor Day, offices are supposed to open up. I mean, is that an indicator you're looking for? So again, kind of just generally your view on the gateway markets, overblown issues, and just kind of generally how you guys are looking at it.
Sure. I think when you're looking at gateway markets versus suburban markets, it's always a sub-market story. So within the urban core, every corner is different. Every opportunity is different. So as far as overblown, I think in New York City, we are starting to see a bit of a bounce back, and you see folks like Jamie Dimon from Chase and David Solomon from Goldman saying you're coming back to the office. If you look at the West Coast, there's a little more flexibility from working from home environments. So some in the Bay Area may take longer to bounce back. So maybe that is not overblown. But I think we're going to end up with some type of hybrid work from home model. Most companies, that's what you're seeing the most of, the post Labor Day, as you mentioned. And what I see most in companies are saying that they want their employees in the office 3 days a week is probably what we're seeing the most. So I'm back. Sorry about that. Someone hijacked. See, work from home. It's a thing of beauty. Look at that.
Well, I was even going to jump in and say what makes this different as opposed to an in-person panel, again, is these kind of things. If we're on stage, it's obviously you're not having to navigate these things like we were planning beforehand. If I have to drop off for some reason, Jeff will step in. I mean, that doesn't happen in person unless I were to fall off stage.
Yeah, I wanted to keep everyone on their toes. So I bounced back. I may have lost my train of thought and where I was going, but the most important thing is I'm back.
Well, and digging in a little bit as far as the gateways go, I mean, has this proven? I mean, is it the way you guys are looking at it? Does it almost require kind of with sub markets navigating it? I mean, do you need like a specialized focus on those urban core markets, or is there still opportunity?
Well, first of all, I think Mike and Jeremy did a wonderful job covering, the characteristics and what's going on right now. Historically speaking, Crow Holdings has not been a major investor in the gateway markets, and primarily for one reason is because they're expensive and they trade for low overall returns, and we're, up until recently, more of a value add fund. That being said, the return of the markets to me is not if, but when. And I was recently with a number of my colleagues from New York, and there is all this discussion about let's go back to work, Labor Day or after. There are all these discussion about work from work versus work from home. We are a work from work business at Crow Holdings. That's part of our culture. We're all in Dallas, and so it's getting the family back together. And I think that that's going to continue in these gateway city markets. I mean, San Francisco, LA, Chicago, Boston, New York, DC, they're not going away, but they have been hit hard, and they have experienced as well a lot of I'm not going to say delinquencies, I'm going to say bad debt, on one's income statement because people, in many of those markets, have chosen to not pay their rent. And with the no eviction policy, I think it's going to take some time to work out from all of that stuff. But that said, and to your point, Chase, and yeah, it is very much more micro specific, product specific. And I think that the product, the evolution of the product going forward is going to be just as critical as whether you're on a transit line or whatever the case may be.
And can you talk a little bit more real quickly about that?
As far as follow up there to Dodge's point on the product, it's critical. I think you saw a trend pre-pandemic to go to smaller units and bigger common areas, but now if you're going to folks working from home, you're going to want a bigger unit and then supplement it with the common areas. So I think Dodge is spot on. It's not only the location, but the type of product.
Yeah, and look, and then think about demographics. I mean, we now have the millennials starting to age a little bit. They've delayed their life-changing events to 30 and 32 years old, women and men respectively, and they're starting to have these families. And this, COVID was an accelerant in a lot of cases to what their next life step was going to be. And sometimes that life step is not necessarily single family home. I mean, the average home price today in the United States is $350,000. And that I've never seen, obviously never seen anything like that in my career, but that is making people to have that experience. They're either going to go to single family rental, or they're going to go out to Jeremy's point in a suburban location, possibly have to put up with more commute, but they're going to get 500, 600 square feet more for the same amount of money.
To Dodge's point, I mean, over this past year, housing prices in the U.S. have gone up, depending on which metro you're talking about, 15 to 20%. I mean, we just created millions of more people that have to rent by necessity instead of renting by choice, right? So the demand is going to be really strong. And let's face it, as a country, we don't do a particularly good job of supplying housing. We don't build the right stuff. Usually we don't build it in the right places, certainly not at the right price points all the time. So there's a big mismatch there that needs to be fixed.
And I think, households are continuing to form and life events are happening later. But I also think, younger folks want the financial flexibility that goes with being in a professionally managed multifamily. They don't want to be tied down to a home or a mortgage. People want the flexibility. Now, we'll see what happens here post-pandemic if that continues to be the trend. But you think that's going to continue to be the trend going forward, is people want to have the financial flexibility, which you get in rental.
Yeah, and we didn't even think about student debt and the impact that $1.7 trillion impairs the ability to even qualify for the down payment and the loan as well. But look, if I think Mike has a wonderful point about affordability. We too are doing some workforce housing, which we are basically defining as 70% of AMI is a qualifier for your rent. The challenge there is how far out do you have to go to find the land that you can afford to build it? But we're seemingly finding ways to do that as well.
Yeah, I think the land piece is important. I'm based in Cleveland, so we're in the Midwest. So if you have, there's a not in my backyard mentality. If you have a well-located suburban asset where there's no new land to build on, that's one thing. You could look at the market, and this is not because Dodge is with Crow, but some of the markets in Texas, maybe it's a little easier to build. So every market is a little different as far as kind of the land and how far out and commute, or if you can even build suburban multifamily at all in certain markets.
Hey, Mike, can I ask you a question? I kind of already
Sure.
did. When you look at your cost of capital on your affordable focus, is that dramatically different than some of your other funds as far as the preferred returns and the targeted yields?
It's a great question. Yeah, the returns in this strategy are well, I'm going to argue that they're probably going to be comparable to a lot of value add strategies in multifamily without the J curve risk. We're doing these units with the purpose of trying to keep them affordable. So it's either naturally occurring affordable. In some case, it's voluntary rent regulation in exchange for some sort of relief on taxes. So you can get to the same NOI pickup a couple of different ways, but we think we're doing it in a way that is certainly less disruptive to the residents, less damaging to the overall community, but probably from the perspective of our investors, a little bit higher current yield, but also not taking that J curve type risk of emptying the property out to redo all the units and displace the tenants and raise the rents and all of that.
When you guys are looking at, I mean, again, we've referenced kind of demographic, economic trends. There's a student debt as an example. There's a lot of things that on the surface seem to value secondary suburban markets. Is there, I mean, just as far as demand drivers still for the gateway urban core markets, because I look back 3 years ago, I mean, we were talking about mega trends, long-term trends of this urbanization because of convenience and all those things. I mean, what demand drivers are still there for urban markets, or are we kind of having to revisit all of that?
Oh, I look, there's no doubt that you're seeing, a flight to more business friendly, lower, state income tax environments today. And that's something that many of these gateway cities, that's up to them to come up with how they can figure all that stuff out. I think I'm not going to get my hand into politics on all of that stuff. But the fact of the matter is that they're still money centers. They're still financial centers. They're where these companies and they've been forever, and they want to be there for a long time, and they're going to remain there. The question really is going to be, what's their workforce going to do? And what are they going to require of their workforce? And, because, people live in New York City because they love the New York City lifestyle. And I completely understand that. And I'm saying that coming from Dallas, Texas. So, I have a very high degree of confidence. I don't know how long it's going to take, though. I just don't know. You're not going to sit there and it's going to flip a switch and overnight, because I don't know what the migration was, Mike, you probably know what the number of folks that left, New York City during the pandemic.
Yeah, you really have to differentiate between people that left temporarily and people that left permanently. There's really pretty little evidence that really large numbers of people left forever. If you just look at like mail, U.S. Postal Service records, people requesting a change of formal address, there's very little of that. But certainly a lot of people scattered because there wasn't anything going on in the city. There's no point in being there, right? You couldn't go to restaurants or theaters or any of that stuff because it was all shut down.
Right.
But look, there's been pandemics as long as there's been people, right? And London lost 90% of its population in the 1600s to a pandemic, and it's still one of the greatest cities in the world today. Same thing's true with Tokyo, with Paris. In New York, New York will be more important 10 years from now than it is today. I'm pretty certain. San Francisco, the same thing. But there's other places that are coming along. I mean, the Austins and the Charlottes and the Nashvilles of the world are getting to scale. They're getting to be big, significant places with diverse employment bases, attractive, all the things Dodge mentioned, attractive places to live from a cost perspective, from a weather perspective, though we should caution weather perspective currently with some of the stuff that's happening with change in climate and whatnot. Who knows, right, going forward? I mean, who would have guessed that big chunks of Germany and Belgium would have been wiped out by floods, right? This past week, there is stuff afoot, as they say.
Yeah, Mike, to your point about the Austins, the Nashvilles, the Charlottes, I think the demand drivers and the population growth is huge. It's the infrastructures of the cities can keep up. So people are going to be moving there, households are going to be formed, but is congestion going to be even worse? And then circling back to the urban piece, I tend to think it'll bounce back quicker as well. Part of that is muted supply. I mean, banks were knocking me out construction loans over the past year and a half to start, pulling permits to build new buildings in some of those gateway cities. So, the urban new development really has come to us slowly. Now there's absorption of new units that need to take place of buildings that were underway that we're opening up. So there is supply, but from a supply demand imbalance, obviously we think the demand drivers are there for multifamily in the interim and the long term.
And is that, as far as supply demand, kind of staying on that point, I mean, looking nationally, or again, we can even focus on Gateway, but I mean, when it comes to, I think we've continued to hear Class A was kind of what was really the focus being built. I mean, is the supply demand dynamics looking forward between, A class, B, C, kind of how do you view that across not only the urban gateway, but also down to secondary suburban? I mean, is it the same kind of supply demand dynamics at play when it comes to that?
Well, we're undersupplied. I mean, fact matter is, and Mike mentioned that before, we're simply undersupplied, whether it's owned housing, whether it's rental housing.
Yeah.
I mean, there's a study out that says that we need to provide 425,000 rental, multifamily rental community homes units through a year through 2030. And right now we seem like we're building a bunch, and it's 375, 400,000, depending on the metric in which you're looking at, and then you tack on the fact that home prices are now 350,000, and no one can afford those, and we're still 3.8 million undersupplied in owned homes. So we got to fix that. I think Mike's strategy is a good one from the affordability perspective, but at the same time we need to build some more properties.
Yeah.
And build them and try and keep them affordable. I mean, look at rents coming out in the last quarter. I mean, rents are back before pre-pandemic.
The problem is virtually everywhere. Every metro in the country has a significant share of its renter population. That's what people refer to as housing cost burden. They're spending more than 30% of their income on rent. And if you're spending that much of your money on your housing costs, you don't have that money for childcare, for healthcare, clothing, food, transportation, education, all the other things that families and households need to be successful, to be stable. And we've spent a lot of time going around the country and engaging with local housing authorities who are desperate for institutional capital to align with them, to look at this problem from their perspective and try to figure out a way to work. The first handful of groups we met with just sort of just stunned. They're like, nobody like you's ever come to talk to us before. And I think the opportunity is really ripe. The country's sort of in the mood for a big push on infrastructure right now. I would argue that this portion of the housing market is about as close to essential infrastructure as we have. For so many of our what we now think of as our essential workers, our police officers, teachers, healthcare workers. This is where they live, and there's very, very few choices available to them.
To Mike's point on the 30% rent to income, as an investor standpoint, you don't like to see that either, because it really doesn't leave any room to push rents. So, if you're depending on the market, some markets you need a car, some markets you don't. But when you're bumping up to that 30% rent to income, it's not going to allow you to hit your underwrite of 3% annual rent growth a year. So, from an investor standpoint, that's obviously a concern as well. Affordability is a big piece of what we look at.
Well, and jumping in real quick, one just kind of housekeeping reminder for the audience. Just if you look at the bottom, you'll see the Q&A icon. We've had some people ask questions, but just for the audience, we've got about 20 minutes left in this panel, so we want to get the audience engaged. And on that note, with the audience engagement, and Jeremy, to your last comment about affordability. So, I mean, it was brought up as far as how do you see the competition of single family rental relative to suburban garden style product, and will someone renting a 1 to 2 bedroom apartment be able to afford renting an entire house, or will SFR compete more with traditional home buyers? So
our thought is at Stepstone is that for sale housing, single family rental, and multifamily can all coexist together. The growth prospects, we think, in all three types of basically housing, that, you know, there's tailwinds behind all three. Single family rental is an interesting one. You know, it's we're now seeing purposely built single family rental communities. Some single family rental managers are buying strictly off the MLS to build up that portfolio. But, you know, it's a nice option for someone that maybe is outgrowing a traditional multifamily unit and does not want to have the down payment, or has a student debt situation where they want to, you know, start a family, and maybe the best place to do that is in a single family rental. But we don't think it's an either or. We think all three can coexist well together.
Yeah, we've been pretty active in the purpose-built single family rent, you know, an apartment campus where each building is a single unit building. And we found that to be pretty attractive to the older slash maybe a little bit higher income millennials who are leaving urban areas that have a lot of amenities, and they want to be in that next ring of suburbs that still has amenities, not way out, you know, but they can't afford to buy there. So it's right for them from a life cycle perspective. And it's in those suburbs that have more to offer, I think, for families that are still relatively young.
Yep, schools are important.
Schools are super important. That's the whole thing. Let's face it, our urban areas they've never fixed the school problem, right? So people get to a certain age, they start having kids, and the first thing they do is look around and say, well, what schools do I have available to me? And in most parts of the US, in the city, you don't have a lot of great choices, at least not in public schools.
Yeah, no, that's something that, again, as our prep calls before this, that was something that was brought up a lot. One of the questions that just came in, I think it again kind of ties in. Do you think that affordability difficulties will ultimately lead to some headwind for multifamily? I think that might just be in general as far as pricing, things like that. So any thoughts on that?
Well, at some point in time, and look, we were getting into it heading into COVID. You know, a lot of the gateway markets, to Mike's point about renter qualification, were well above 30%. And so you kind of somewhat do have a self-fulfilling prophecy here, that people, you know, are going to hit so much. You know, that's part of the challenge, at least the way that I view it and we view, you know, where we're going to invest is we've got to find those markets where we think there is, you know, a gap to go, if you will. And, you know, with what's happened in the last quarter recently, you know, we quickly came back to where we were before. So we're gonna have to be very cognizant of that, because if folks can't pay for it, then they can't pay for it. And so, yeah, that obviously is something that we're going to continue to watch from this point forward. Always do that.
And keep in mind this migration of people that everyone's focusing on, people leaving, say, the Bay Area, New York and whatnot, going to Florida, Texas, other lower cost markets. When those people move in, they displace a lot of renters because they're used to, you know, they think nothing of paying higher rents than what that market had historically. And they come in and they pay, and they think it's cheap compared to where they're coming from, because presumably they're probably still getting paid pretty much what they were getting paid before. That may change in the future as well. But so there's a huge displacement effect that happens when people come from more expensive markets to lower cost markets, and it ripples right down through the whole housing stack, and really disproportionately hits those moderate income households because they quickly get pushed out.
Yeah, when you think about the construction pipeline, people are building to A, quality. You're not building to C, quality. So you're building in a great market with a brand new building, highly amenitized. So then there's that trickle down effect that Mike mentioned, because the buildings that are being built, either suburban or urban, you're not building C type quality. You're building A quality, and thus the rents that are needed to, you know, make that work are going to be too high for.
You kind of have to, because all these jurisdictions make it so difficult in terms of zoning and regulations and you know, communities that are resistant to multifamily moving in. Like, well, I'll just say where I live out in the Boston suburbs, almost every almost every town in the Boston suburbs, if land becomes available, they buy it up and put it in conservation trust, because families that move in with kids cost them more in school services than they get out of the property tax from the new units. So it just makes sense for the towns to buy the land up.
Mhm.
You almost never get you never get any expansion of the stock.
And is
Yeah,
that,
and then, that just places added pressure in these value add opportunities. I mean, look, the value add game is basically going to end up with a not like new delivered product, hopefully at anywhere from, $200 to $500 a month less in rent than the new product. And that, that's one reason why you've seen the activity levels, the transaction levels doing this. But Mike's point's a great one when, we're constantly being asked to help with affordability. We're constantly being asked to help with housing, and then they make it hard to do so. And so, and so it is what it is. But that and the other, and look at manufactured housing. We haven't even touched on that sector in this call. I know we're talking about gateway cities,
yeah,
but look at the attractiveness, and again, you just have such huge capital desires for what I'll just call residential housing, residential rental housing, and that's foreign and domestic, so that's just, we've got to figure it out. We've got to continue to provide these things. But when you look at where jobs going and where's growth going, and the demographics are what they are. I mean, you've got 75 million screaming Gen Zs coming on the heels of the millennials.
mhm,
I think the oldest Gen Z is 24 today, so they're just hitting their stride in rentership.
mhm,
You know,
And at
and
least half the boomers have really no financial assets for retirement. To the extent that they have any assets, it's a house, and they're going to have to figure out a way to get their equity out of that and still have a place to live. So there's,
mhm.
I think it's going to be interesting watching the single family rental, the build to rent that you talked about, Mike and Jeremy, and see that, because that's going to give a boomer that sells their home, that's going to give them the most comparable experience. I mean, they're not going to have to walk down a common hallway. They're not going to be able to park in their own garage, and it'll be interesting to watch the boomer impact on that.
where I live, a lot of, not a lot, but a number of seniors are starting to take in boarders again, which is something we had, pre-World War II. And it's sort of coming full circle, right? They took in boarders back then for the same reason. They got too much house and not enough cash. And you take in a boarder or two, and you fix a couple of problems.
Yeah, I think one
I'm not
positive.
saying that's going to become a large scale thing, though, but it does work for certain families.
If we think about a year from now and how the asset classes were performing, multifamily was very resilient from a rent collection standpoint. The opportunities set for investing, office, too many unknowns, retail was already a problem going into the pandemic. Industry obviously performed very well, but cap rates compressed very quickly and became very expensive. And I think the steady eddy has really been multifamily. The collections have been there, households are being formed, and people want, as I mentioned earlier, the financial flexibility to rent. So as we look at how residential or multifamily fits in with the other asset classes, it really has been attractive through difficult times and will continue to be.
Well, and jumping to you, Dodge, when it comes to outside to the secondary markets, I mean, how have you seen kind of the evolution of demand? Like we talk about renters by choice versus renters by necessity. I mean, when you go to those markets, and maybe tying this in with kind of Class A and urban, I mean, my simplistic view would be those are renters by choice, that they want to just rent. They don't want to have the liability. They just want to have one door to lock. They can just go out and go enjoy the city. I mean, how is it in kind of the secondary suburban markets?
Well, it again, this whole work from home concept, this whole COVID really accelerated what we were seeing. We have really been doing 95% of our investing in, the secondary Sunbelt markets. But, look at some of the secondary markets. I mean, Dallas technically is a secondary market. Okay.
Yeah.
Denver, technically a secondary market. Look at what's been going on up in Denver. And a lot of that is that's where the jobs have transitioned to. That's where you are seeing population growth. Look at some of these towns, Clemson, for example. where they have major universities, what's been growing up around them.
Mhm.
And so this is not a phenomenon that really happened overnight. It was a phenomenon that was in process. It was a phenomenon that was happening. People were wanting to not only go to secondary markets, they were wanting to go to suburban locations and secondary markets, because with millennials and with these Gen Zs, their quality of life is as important as any decision factor that they have right now, and that's where they're going to feel they get that greatest quality of life, and it's so individualistic. But at the
Mhm.
end of the day, it will come down to cost, and it will come down to ease of doing business and things like that.
Yeah, I mean, I agree with Dodge about Dallas and Denver as two examples of secondary markets. I would add another category in tertiary markets. Those are the ones that maybe were considered secondary markets a generation ago, but ones now you'd say, I'm not so sure. Do they
Mhm.
have the velocity of transactions? That's another institutional investors are looking to buy and trade assets in these markets. If you get too far down from secondary to tertiary markets, you're not going to have the liquidity when you're looking to sell that asset. So we kind of look at it as primary, secondary, and tertiary markets is kind of a third category.
Yeah,
Yeah,
another
that-
overlay you need on this is really how much those local communities have prepared for the growth they're getting, whether they've done the necessary work on infrastructure, light rail, water systems, things like that. I would argue a place like Charlotte and Denver have. Some of the others that I mentioned maybe less so. I got to believe that one of the big constraints on growth over the next decade and beyond is going to be the water issue. You look at what's going on in the Western United States with Lake Mead and starting to shut off communities' access to water, things like that. I mean, that was the thing, Dodge. You probably remember this back in the 80s. That was the constraint that Atlanta had for a long time on growing. That
Right.
they can get the water and sewer hookups,
Yep.
and had to have more like rolling moratoriums for periods of time. I got to believe that's coming to more and more communities as this growth continues to accelerate.
Mike, are you
Yeah.
saying I look too young to remember the 80s? Is that your way of saying
Oh
that?
no, I didn't. And it wasn't.
I was coming at it from the exact opposite way. It's like, wow,
Sorry.
that's
You can't bring up age and never. I should know this. Yeah.
We
Well,
were both going to jump back, right?
Well, to your point, Mike, we actually, on our infrastructure side, even just last week, we had one of our roundtables, and one of the investors had brought that up as far as water and talking about the Southwest and the amount of water rights that were basically sold, basically 5 million water rights, and there's only 3 million that are actually available. And just eventually that's going to come to a head.
The aquifer in the Western Plain states is dramatically low. It's I mean, hopefully it all works out, but this is sort of the breadbasket of America, right?
Yeah. Again, wanted to get the audience involved. We have a few minutes before we want to get your guys' kind of parting thoughts. But a couple questions have come in, so I'm trying to sift through these and make sure we're able to address them. So one of them that came up, because we haven't got really into too much detail on kind of the macro as far as cap rates, things like that. So one of the questions was, with cap rate compression and low cash on cash yields, do you see the market shifting firmly into the institutional arena? Maybe that's across markets too. Maybe add that as a caveat from that question.
Well,
I do.
I don't think institutions want to overpay for assets either. Just so then I don't know if it's to become more institutional. I think it's just is there price discovery between buyers and sellers, and with cap rates compressing, sometimes it can be difficult, especially during this past year, of knowing where cap rates would settle. So I think having that price discovery between buyers and sellers is important.
Mm-hmm.
Have cap rates settled? I don't know. I honestly don't know that they have. And I think Jeff made a comment to this in his opening remarks about the fact that anything that had to do with the bed was persona non grata from an institutional perspective. But when you look at the stickiness of the NOIs in the residential rental sectors across most of the sectors, that is attractive to institutional investors. As far as markets go, I don't think that Crow Holdings or myself would ever sit there and say we're not going to invest in a particular market because of X, Y, and Z. It's going, I would rather change our focus to which markets we're going to invest because we love them for the, for those reasons. But yeah, I mean, you look at where yields are now, you look at where debt is now, it's pretty full. It's pretty full.
Mm-hmm.
Yeah, that's really the key. The cap rates won't stop compressing until the debt costs stop going down.
Yeah.
I mean, as long as you got that spread, it all works, right?
Mm-hmm. Let me bring in one more question. So, and I think this is good and might be something you guys can also address in kind of your closing comments. So someone just kind of outright asked, I mean, just to get everybody's perspective, which markets do you feel have the most potential for growth in the US? Maybe just start there with you, Mike.
There's a bunch. Ones that jump out in my mind, Riverside, California, I think has a lot of those characteristics. We're going to have a pretty sharp recovery in the gateways, the San Franciscos, the New Yorks. We're already seeing it in our own portfolio, both in terms of occupancy and rents and concessions burning off and all of that sort of stuff. And then there's a handful of markets where the growth is just off the hook, has been for a long time. I mean, Dodge mentioned Dallas. I mean, all the Texas markets have great growth characteristics. I guess the issue is going to really be, think about a place like Austin. Are they, what is the daily congestion footprint going to look like as we come out the other side of COVID? It could be a little tough, at least in the near term. But we're active in the Carolinas. We're active in Florida, and we're still active in parts of New York, Boston, San Francisco.
Mm-hmm.
Yeah, I mean, I would say the Sun Belt, just in general, if I had to say, some people call it the smile market, some people call it a crooked smile all the way up to Portland and Seattle. I mean, that's the easy answer, but I'll circle back to what I said to really open it. It's a sub-market story. So within every one of these big MSAs, there's going to be a pocket that is prime for growth and prime for rent. So it's really within the sub-markets within each broader MSA.
I don't have much to add. I agree completely with Mike and Jeremy. You look a little interior and there's some really intriguing plays, which we talked a little bit about Nashville, but you can look at a Louisville. Really interesting things going on in Boise, but does that have the staying power that pure institutional investors would like to see? Too soon to call. Denver, Denver's obviously been doing extremely well. A little known market like Kansas City, but when you look at jobs and when you look at percentage of new jobs on an annual basis in markets like that, it's quite impressive. So we will continue to. A lot of Florida markets have come about coming out of COVID as well. So it looks like I'm going to be competing with Mike and Jeremy on these new investment opportunities quite a bit on a go-forward basis, and look forward to the competition.
Well,
Absolutely.
and I think that. Well, I was just going to say real quick, I think one thing, because we heard it on our editorial board back in April, I think, again, one of the things, and I think Jeremy really hammered it home, was just the difference between really kind of three categories. It's not just kind of the primary to secondary. I mean, you're kind of talking about 3 or maybe even 4 categories. If you're kind of going down to these kind of secondary markets, again, Dallas, Denver, are those really, that secondary compared to a New York and things like that. So I think that's one thing that I think needs to be brought up more. We had another question. I think this ties into to the water. So let's get one more question from the audience, and then we're going to go to just kind of our parting thoughts. So the question was about Mike. I think this was a while ago, about your comments about climate change. So markets you think are most vulnerable, and again, I think we might have answered this a little bit with talking about water. But I mean, as far as other markets you're looking at might be vulnerable to, water, things like that, just, I think maybe even broadly infrastructure. I mean, just some of these markets keeping up with infrastructure. So,
yeah, well, I mean, the short story is virtually every market in the United States is vulnerable on some dimension of climate risk, right? Whether it's heat stress, hurricanes, tornadoes, water, too much water or too little, right? So what are you rooting for? I saw I went to a thing at MIT a bunch of years ago with this, I think he's passed away now, this climate scientist, and he said, rule of thumb, whatever you have now, you're going to have more of it. So if you're hot and dry, you're going to be hotter and drier. If you're cold and wet, you're going to be colder and wetter, and so on and so on. And it seems like it's largely playing out that way. So it's a concern virtually everywhere. Obviously, places on the coast are in great peril from rising sea levels. As a country, we're going to have some sort of organized, what climate people call managed retreat, which sounds kind of horrible, but it's recognizing that we can't all live within 10 miles of the coast, right? And you're going to have to pull back, and that's going to involve enormous sums of money, both from private sources and from public sources. I mean, you look at what happened to the New York airports in Superstorm Sandy. LaGuardia and JFK were under 10 feet of water. I mean, having major airports at sea level is a dumb idea, right? They're either going to have to be raised or moved. There's not much choice in that, and nature will do that. Make us realize that we can deny it as long as we want, but when your airport's underwater, it's underwater. There's parts of the United States today where at certain times of the day, an airplane can't take off because the ambient temperature is above 110. You get between 110 and 120, you can't get any lift under an airplane wing, and that's been happening in parts of California, parts of western slope of the Rockies. So we got some serious problems here, and it's not unique to multifamily. It covers really every property sector, in every community, as I said. Each one has different challenges, and each one has somewhat different ability to respond to those challenges. And that's really an important thing to dig into, I think, right now.
Mm-hmm. Well, and again, wanting to get kind of just some closing comments, maybe start with you, Dodge, as we're wrapping up here. Just kind of your closing comments, thoughts.
Yeah, well, first of all, thank you for allowing me to be part of this, and Mike and Jeremy, it's been great to to speak with you guys leading up to this. We have to house people, and we have to figure out ways to house them affordably.
Mm-hmm.
And that it's just something. It's going to take a lot of effort. It's going to take a lot of compromise. It's not easy to go out and build an apartment community, but I would tell you this: there are some markets that are extremely much more difficult than others in which to do so. And a lot of those markets are a lot of the markets that do need that supply. So we have to figure out how we can be, just as good investors, good developers, good operators, and be good landlords to these renters. I mean, look, you've seen the home ownership rate tick up to about 65.5% of late. That's still down from 69.5% heading into the GFC. That's a lot of folks that are capable of owning a home, but are choosing not to. They just can't. So we have to be focused on that and be thoughtful about that.
Yeah, Jeremy.
Thanks, Jason, and thanks to you, Dodge and Mike. Appreciate the discussion and the time. Maybe one way just that we would look at it a little differently at Stepstone is our advisory client base. They want to be equal to overweight on multifamily. So I think the institutional real estate market is still very, very bullish on multifamily as an investment opportunity. And to Dodge's point, we're going to have to figure out a way to do it where people can afford the rent. So there are the tailwinds, the propensity to rent, and the demand drivers are there. And we still see a lot of opportunity going forward as an investor into the multifamily space.
Mm-hmm. And Mike.
Yeah. So thanks to you, Chase, and Jeff, and the whole IREI team. Dodge, Jeremy, thank you. If we learned anything during the pandemic, we learned that housing is essential, right? People need someplace safe to live, to raise their kids, to maybe educate their kids, maybe to do their work if they have to work at home. And there's a big chunk of America that is constantly on the brink of having that essential housing available to them. And, we're not going to fix it alone just with what we're doing. Collectively, we're probably not going to fix it. But if we don't start soon, this problem is just going to get bigger over time, not smaller. That's certainly been the case of the last couple of decades. there's tons of opportunity in U.S. housing everywhere. It's the biggest, most liquid asset market in the world, U.S. housing is. And I don't think there's enough institutional capital in the asset, whether it's single family for rent, multifamily. It warrants a much bigger allocation, I think, from most of our clients, most institutional sources. And there's a lot of really interesting things to do in the space today that I think are really exciting. And so we're like, as I said before, we're really leaning into it.
Mm-hmm. Well, and yeah, I mean, just to wrap up this group, just want to thank all of you for joining. To the audience, again, we're going to go right into the next panel, digging in a little bit more regarding kind of the secondary suburban markets. So obviously appreciate Mike, Dodge, and Jeremy providing kind of the starting point as an overview between gateway, kind of these secondary, tertiary markets. I would say, I mean, just having these discussions leading up to this individually, being on this panel, I think my key takeaway, I think even just kind of one of the last comments you're talking about, stuff like climate change. We kind of started it with, we've been dealing with pandemics for centuries. It's like, I think kind of same thing. We had the Dust Bowl, 100 years ago. I mean, there's things that are, I feel can be viewed as shocking when kind of it humbles you and you think, okay, well, we have dealt with this before. Water in the Southwest, things like that. So I think that's interesting as far as kind of moving forward, how everything evolves in dealing with those things that are new, but not really that new for humans to deal with. And then I think I've said it to you guys multiple times, but I think looking at U-Haul stats is definitely interesting. Get a pretty good glimpse of where people are going looking at that and the price. So want to thank you guys again for joining, and we'll jump into the next panel and take it from there. So thank you everybody for joining us, and I'll bring in the next panelists. And here they come. Perfect. So we got Joseph, Geoffrey, and Hans. So I called you Geoffrey, very formal.
I start cringing. I think when my mother gets mad at me, that's what she calls.
Yeah. Well, again, just as an overview. So again, we kind of talked about the urban gateway. We're going to now get in a little bit deeper into suburban secondary markets. And like we started the first panel, we want to start with just letting you guys kind of introduce yourselves, provide some background, what you're doing in multifamily, maybe just give a general overview, and then we'll jump into the questions. And I think just to confirm, Hans, you're calling in, correct?
I am.
Okay.
Power outage in this town, but I'm here on the phone.
Okay, perfect. Well, with that said, we'll start with you, Hans. You can just give a brief introduction, how you guys are looking at the market and everything like that.
Very good. This is Hans Nordby. I'm with Limestone Investments, and we're a U.S.-focused investment manager, active in multifamily, office, and mixed use. I've been in business for 20 years, serving separate accounts. We have funds in core, value add, build to core, and we're the U.S. real estate investment division of Columbia Threadneedle, which also has real estate investments in other regions of the world. We manage about $10 billion of AUM here in the U.S., and our multifamily focus is in sort of what we call the hockey stick markets, the growth markets. I'll talk more about in our discussion. And we've got about 5,500 units in the portfolio under development, much of it in mixed use.
Perfect. And jump up to you, Jeff.
Great. Jeff Reeder, Managing Director with Center Square Investment Management. We're a global real estate investment manager, about $14 billion in AUM. Been in business for almost 35 years now. We invest across primarily three strategies: listed real estate securities, private real estate, which we, within private real estate, invest across value add funds and core plus, and then also private debt, where we, again, have core plus and transitional funds.
Perfect. And Joe.
Joseph Kennard, past board member, investment committee member of the Board of Pensions Presbyterian Church USA, and currently board member for Presbyterian Senior Living and Presbyterian Investment Management Services. In terms of real estate, what we're looking at is multifamily and the garden, I shouldn't say garden variety, but but garden communities, things of that nature. Some value add 10 to 25-year-old value oriented communities located in some what we would call high quality areas. We're particularly interested in the southeastern United States. So the cities that we would take a good look at would be Greensboro, Jacksonville, Richmond, Virginia Beach, Atlanta, Charlotte, Raleigh, and Tampa areas around, and suburban areas around there, particularly. But that's our focus, and particularly senior living. We're looking at those areas.
Okay, perfect. I know obviously with power outage, would you able to kind of go
Yeah,
through?
let's go ahead and present those slides, Chase. I've got them up on my screen. If you could just put them up in order.
Okay.
And you tell me when you got it up.
All right. I think John's going to bring that up. So let's give it a second here, because I do think it provides a good kind of foundation for jumping into this conversation, just kind of providing some context. So wait for John to bring that up.
Exactly right, Chase. I think that's exactly right, Chase. And while he's bringing it up, and let me know when it's there, I will say I thought that was a great setup to our discussion with Dodge and Mike and the entire panel. And what I want to do is something a little bit different, which is go through a couple of slides, as Chase said, diving into what's going on, and do something a little different than what I think most of the attendees are going to hear on different panels. So is it up on the screen?
Yep, you're good.
Great.
And John's going to click.
So
So
that's perfect, Chase. Thank you. So first, just to kind of set the table, and I think this ties into the previous panel and set something up for everybody on the current panel to comment on. So the discussion right now is primary versus secondary markets, but of course we're all wrestling with also urban and suburban in terms of a divide. And I want to bring in a factor that again, you don't hear in a lot of panel discussions like this, how the for sale housing market is driving the for rent market, and dive into that and what it tells us about the economies. So you see here in terms of demographics overall, it's a very dry concept. What I would say, I'd point out, and go to the second slide here. So what you probably don't want in demographics is what you see in the upper right here. That's overall US working age population growth, which is 0. And it's really hard to fill buildings, et cetera, when demand growth is 0. But not all markets are like this. This is the US average for all working age population. Go to the next slide. You can see if we look at what we call the hockey stick geography, and you go to the 30 to 34-year-olds, demand growth is on fire. That's over 3%. So a lot of wrinkles here in terms of which slices of demographics and which geographies. The hockey stick markets, we would say it's the upper left-hand corner of the country, Seattle, Portland, down through the Rockies, into Texas, over into the Carolinas. Now, a previous panelist mentioned, the crooked smile. So I think a lot of us are thinking of the geography as not coastal, not high rise, probably not California and New York in the near term. Not that all of us wouldn't be very active in strategies there, but we're talking about growth markets in terms of growth demographics. That's sort of the definition. So,
and just to confirm, Hans, on this slide, we're on the bottom. It says page 3. Is that where you're on? Or jumping to?
Yes, that's exactly right.
Okay.
Thanks for asking, Chase. So bottom of page 3. So that's sort of set the table. So demographic slices, different regions of the country. So let's take that as a given, and that's why a lot of us are looking at these previously defined secondary and tertiary markets. As the demand growth is better, but it's different. The last 10 years, we've been building places to play for 20 to 30-year-old millennials, and the next 10 years, arguably, it's more about the 30 to 34 and 35 to 39-year-old group, which have slightly different needs. As others on the panel earlier today mentioned, a lot of that has to do with children, larger households, more work at home, higher income levels. It's just different than the last 10 years. Next slide, number 4. Let's look at the housing market. And the question you could ask is, what are we talking about for sale on a rental housing panel? But rising prices in the for sale housing market have a knock-on impact on demand for and rents for rental housing. And second, the for sale housing market, we believe, is an interesting medium term, say 2 to 3 year forward look on the health of the local economy, especially when you compare the housing market in one city, which might be only slightly up, to another that is very strongly up. That tells you something. When people are willing to buy homes, they're saying they want to spend time in that location, and that's a precursor to job growth, or rather a coincident indicator in some markets. So this is what the for sale housing market's doing in Raleigh. And on the left in blue, the regions in Raleigh-Durham, which had 10% plus housing price growth in what I call the demand pandemic year, February 2020 to February 2021. It's all good, no red, nothing fell. And on the right in blue is the post-pandemic environment, starting in February this year when those inoculations really got underway. And here we got those areas that posted 5% plus home price growth, according to the Zillow data, in those 4 months. That would be like a 15% annualized growth rate. And it is all straight up. Next slide, please. Well, this is Austin. And this is just comical, right? It's all good. You get one little urban area that didn't post more than 10% last year and didn't post more than 5% in the post-pandemic environment, last 4 months available, but it's all on fire. Okay, so that's good. That's Raleigh and Austin. Let's compare that to some of these big coastal markets, the primary markets. Next slide, please. We see here is the Bay Area. On the left, you can see in red are areas that had negative home price growth, February 2020 to February 2021, the pandemic environment. Urban, higher density, what had growth in blue? Well, the East Bay. So if I can work at home and I need some more space, where would I move to? Those are the areas that grew. So everything changed and people saw the inoculations, the vaccinations, the normalcy coming on the right. This year, urban San Francisco is flat to down. There are pockets of growth and it'll probably pick up, but compared to the markets, secondary and tertiary, it's kind of a sad story. And then again, more suburban areas doing better. So what does it tell us? So the first couple slides told us where people are moving to, where people will write a check for, given the fact that they might be able to work from home or their employer relocated. And then secondly, on the margin, where demand growth is within metropolitan areas, because it's not all about cities versus cities. Oftentimes it's submarkets within cities. Next slide. New York. New York, like San Francisco, had some demand growth in bedroom communities, but mostly it was flat to negative, red on the left. And most recently this year, it's going down in more places, which is surprising. I think some of the new data coming out since May will show the market peaking back up again. We'll gain some this year, but as a precursor to demand growth, and fairly poor story. Next one, Atlanta. Very similar story to Raleigh and Austin. So was good, more suburban, is better, less suburban. So let's drill down on Atlanta a little bit more. Next slide, where you have the supply, demand, and vacancy graph. You can see here, supply, demand, and vacancy in Raleigh, we've reached near historic lows in vacancy rates. And that's not very Atlanta, right? Because investors knock Atlanta as a low barrier market. Well, low barrier was a little bit disproven in some of these coastal markets, and that while it wasn't a layup to build, it was not impossible, as we saw from the levels of supply in New York and LA, et cetera, the last decade as the cycle went on. So I'm not completely in agreement with this forecast, but I think the state that we're at now, with the highest absorbed units in history in a single quarter in Atlanta, says something that ties into the expansions by Microsoft and Amazon and other firms, particularly to the best submarkets here. And then just to wrap this up, again with Atlanta, last slide, this is what all of us who are tuning in today and all the panelists wrestle with every day. You've got the mega trends between cities, urban versus suburban, and you buy assets, one property at a time. So these are the different submarkets in Metro Atlanta. Further to the right has a higher percentage of inventory underway. And further up on the left, on the y-axis, has higher annualized demand. Any submarket that's above the dotted line has higher annualized demand than supply. And, a little bit of a red, green, yellow stoplight format here. Green means the vacancy rate in the submarket is less than 5, yellow 5 to 9, and then finally above 9% is red. So overall, we think that the housing market portends more growth in the secondary and tertiary markets. We see it in the for sale market, which are very tight all over the country, especially in a lot of these growth markets. That's going to drive demand growth and rental growth in for rent housing. It's complicated because these markets, people move there for the low barriers and they're going to get supply. So it's not a layup. And then finally, different submarkets are going to behave differently. All these things makes it very interesting to be in the position of the folks on this webinar today. So with that, I'll stop talking and turn over to the rest of the panel.
Well, no, I appreciate, because that does kind of lay a good foundation, just kind of visualizing this migration. Again, I referenced U-Haul stats previously. We've talked about this, just to visualize it, I think helps. Jumping to you, Jeff, I mean, kind of with those maps kind of as background, I know you guys had a white paper Beyond the Gateway where you were talking about things like that. I mean, jumping back, does COVID get too much credit for making people go to these markets, or were there other things at play that you guys have really seen that, again, COVID maybe added some acceleration, added some noise to it, but things were already going in a certain direction?
Yeah, thank you, Chase. That's a good setup, and thank you, Hans, for the slides, because I think that lays a great foundation. To answer your question, yes, I think COVID gets a lot more credit than is deserved these days. My partner and I put out our white paper called Beyond the Gateway. That was 5 or 6 years ago. And the thesis, again, was all about where do we see population growth and job growth. It came down to affordability. And then also, Hans made the point about, the supply myth, right? Supposedly constrained, but we were seeing a ton of supply because that's where the capital wanted to go coming out of the GFC, big, safe gateway markets, liquidity, and we were seeing oversupply in those markets, which was also a factor. So this is, a 5 or 6 year old trend in terms of moving and expanding to these, I'll call it primarily Sunbelt markets, but yes, you have markets like Denver as well. And, COVID really, that just, again, shined a magnifying glass on it, but these trends were happening beforehand. And again, the markets that we've been targeting, we have our own proprietary target market analysis, which, a bunch of inputs go into it, but you're constantly looking at job growth, which is certainly going to drive population growth. We have a livability index, which factors in things like affordability. So we were focusing on those markets, beforehand. And again, COVID gets a lot of credit for the demand for space. Everyone's saying, oh, well, now people want to spread out and they need extra rooms. But again, that was happening beforehand as well. You look at the largest generation group, millennials, 72 million, they're about 25 to 40 now. Again, starting back 5 or 6 years ago, they were starting to emerge from I want to be in a city, I want to be renting, to, hey, I want to, start looking at the next stage of my life, start planning my routes in neighborhoods with, all the things we talked about in the previous panel, good schools, good housing, start entering that next phase of their life. And that could be, suburbs of some of the major markets, or, with a lot of, flexibility and technology, again, work from home isn't something completely brand new. COVID calls it, immediate, everybody, grand experiment, but, a lot of folks in a lot of industries have been doing partial work from home, hybrid, beforehand, and the flexibility to live in other places where, you're not having to commute every day into the office, that opens up your choices of where you can live. So, we've been looking at, along the multifamily spectrum, post GFC, a lot of the stuff that was getting built was, higher density, skewing towards smaller units, studios, 1 bedrooms, because Canada, that's just where the development math was penciling as well. So we were focusing more on, okay, let's go find the product that's 10, 15 years old, unit mix is skewed more towards 2 bedrooms, 3 bedrooms, we have more space. And again, had nothing to do with, the pandemic. It was just the life cycle of following that major demographic wave, finding neighborhoods with, again, good schools, good incomes. And again, we talked about in the last panel, but millennials just as a generation kind of doubly scarred here, kind of coming out from the, in terms of job market right into the GFC. We talked about student debt. So just had a little bit of, deeper hole to really dig out of in terms of coming up with a down payment. And then you throw on top of that, just a dramatic undersupply of entry-level housing, since the GFC, and that's a formula for renting for longer. But again, these folks who are wanting to rent are going to rent in neighborhoods where they want to start planning routes, developing those family relationships, and something that's more of a surrogate for home-like. So anywhere along that spectrum from traditional multifamily with larger units, maybe some townhome floor plans, to full townhome, all the way up to detached single-family rental housing.
Mm-hmm. Well, and you kind of reference it there with talking about the development aspect. I mean, and I would even take a step back and jump to you, Joseph, as far as kind of the acceleration that, I mean, again, you talk about millennials that they were probably already making plans, let's say, to go get more space, start families, things like that. And again, COVID was just kind of that thing that you're sitting in your apartment in New York, just, okay, let's go do that now. So, I mean, as far as the way you're looking at it, I mean, is part of it, again, these kind of big trends demographically, but I mean, as far as executing like a value add strategy, I mean, is it or I guess not theoretically, relatively easier to execute that kind of in a secondary market versus a primary market? Is that a factor that you look at as you're allocating?
Yes, and it is easier to do. What the previous gentleman has said has been absolutely true. All the demographics tell us this, the economic trends, et cetera. But again, it should be easier, but it still requires us to be diligent in what we do and how we do it. Mm-hmm. And to take our time, we look at the 10 to 25-year-old value-oriented communities, and where we're looking at particularly in terms of the multifamily and garden style, it's also got to be proximate to sometimes grocery areas or transit. That's become mm-hmm. very, very important for us. And in the secondary markets, that's working out. There is going to be more and more transit in those areas, and we think that it's just the right thing for us to do, to position ourselves well and to look at who is, for example, we can also invest in some REITs that are doing that kind of thing, and there's always some private equity. But primarily, we're just looking at the opportunity set and saying that this makes a lot of sense for us going forward. All the demographics are there, and the return on the investment is there. There's going to require some patience, yes, but that shouldn't be a problem. We just think this is the best place for us to be for all the right reasons. And again, when it comes to senior living, one of the things that we're beginning to see is this intergenerational push, and that there's a new senior living model, which says that I may want to be able to live alone, but I want to be able to live on my own terms. Mm-hmm. And that's really important. And one of the things from the previous, I think it was Hans who said about World War II and the bringing in borders, and we're seeing that with some seniors as well. They're saying, well, wait a minute, I don't have to necessarily leave here. I can bring in a person or two, and I'm okay. I will have my medical services taken care of. Somebody can come and see me, or I do mm-hmm. telemedicine, which is something else that was given a kickstart with the pandemic, and that gives them a sense of being able to stay in control of where they are and who they are. Mm-hmm. And we see that happening as we're moving forward. And again, there's people looking for these kinds of intergenerational and diverse communities for them to live in. And we also find with some folks, it gives them a sense of purpose, being able to help somebody younger. Of course, that person may be 50 years old, but
but
they're younger. Yeah.
Well, and I think, one of the things, just taking notes, even as you guys are talking, and again, going back to our previous conversations, I think one thing is, you might have this, huge trend of demographics that people are wanting space. COVID's accelerated it. But I think that you still have to execute properly. It's not just as simple as, oh, you build it in the suburbs, like people are just gonna all of a sudden show up.
Right.
That's, I would say, kind of is that a fair asterisk? Kind of like as far as having proximity to an urban core, how you're navigating that. Just open up to all of you. Is that something that I think is kind of a risk, that it's just, oh, we can just go to kind of any secondary market?
We can't go to any, you have to do your own analysis of this. And the other
Yeah.
thing is that, again, it's going to take some time, but you've got to take a look at how you market this to people. And I know some folks don't really want to think like that, but that becomes how you tell the story of what you're building and where you're buying, and what it can do. That's important. We really need to be able to tell the story and the market it to folks in order to build in long-term engagement and return.
Yeah, it's not just
because a lot of folks are moving out of the more urban markets, they want space, doesn't mean they don't want access to the amenities environment that an urban environment brings to you. So yeah, you have to be very selective in which, I'll call it broadly secondary markets that you're going to. And then we talked about before, right down to the right sub-market. But you're going to look at, okay, how's my transportation infrastructure? What is the diversity of the job base? Because, hey, yeah, I'm working for this one company now, but if it doesn't work, am I going to pick up and move again? Or do I have, another variety of options? I want to be surrounded by, like-minded, like-educated individuals. And is there, a lifestyle choice? Is there a vibe, maybe out in the suburbs, but do I have access to vibrant downtowns? We invested in a market, Greenville, South Carolina. We had studied that market and just looked at the trends, job growth, population growth, rental growth, vacancy factors, unemployment rates, and they all really mirrored, the major Southeast markets, the Atlanta, Charlotte, Nashville, Raleighs. It's just a smaller market. But, as we were doing our diligence and studying the market, hey, you've got a really vibrant kind of regentrified downtown. They invested a lot of money in the downtown Greenville. It's great. And you're 2 hours from Atlanta, hour and a half from Charlotte. That's like me here in Orange County trying to get to LA during rush hour. It's totally makeable drive.
But that's a very good point. Both of my parents were from South Carolina, so I know it very well. And for us, we've been looking at Greenville and other areas like that. The points that he just made were absolutely terrific, because they are things that we've seen as well. It behooves us to really look. You don't have to necessarily be in Charleston. You can look at Greenville and Bamberg, other areas, and you will do just as well.
Well, and there's that balance of, again, kind of not in just the middle of nowhere, like 6 hours from an urban core. Like that's like kind of you get a lot of space in the middle. But I want to get you jump in here, Hans. I know you're about to bring up a point.
Sure. And sorry, I'm making it so hard. But both the panelists bring up a really good point. And they touched on the fact that things are a little different. So it's looking at different markets, but then also looking differently. I think most people in general look at the way things were for the last 10 years and try and build on those trends. And that's natural. But I think we really saw coming out of the GFC that multifamily demand in the economy just behaved differently for that 10 years. And part of it's demographics, part of it's cultural, but we really had 2030 arrive early, and it doesn't look the same. In some ways, people cited the pre-war era. In other ways, it looks like the 70s and 80s. The millennials' parents, the baby boomers, they turned 20, 25 years old. They got out of college. They moved, and these were the years when New York, Philadelphia, St. Louis really suffered out migration, and Los Angeles, Dallas, and to a lesser extent Denver and Atlanta were built. And so the question is, the other panelists bring up some great points with regards to secondary and tertiary markets that are a lot smaller that'll grow. So it's both in terms of the markets, probably be different than that last 10 years. For the last 20 years, it's been overwhelmingly about the coastal markets. I would bet the next 3 years are going to be very tough in New York City. and some other places. And the decade is going to belong to where people move to when they're 37 and not 27. Totally different lifestyle and familial structure, et cetera. So I agree with the panelists. It's about markets, and to your point, Chase, you can't treat it just like you're taking your San Jose show on the road, but it's also cultural changes. Pretty interesting case.
Yes. Well, and one thing quick to note, just for the audience, we said it at the beginning, but I just want to remind again. I mean, as you have questions, want to make sure the audience has a chance to type these in. So you can go on the Q&A icon at the bottom, type in questions, challenge our panelists, things like that. Wanted to take a step back talking about the gateway real quick, that kind of just to see if there's maybe other things aside from, again, people wanting more space, demographics. I mean, are there anything kind of, we talk about back of mind concerns sometimes when we do our editorial board, like what jolts you up at night, not necessarily pricing, because those are kind of at the forefront, but what are some behind the scenes issues maybe you see in gateways that could compound the move to secondary markets, things like that? I mean, is there anything people aren't thinking of?
Well, if I could throw one out, I'd be very curious to see what the panelists and the audience might be thinking. But the federal government really stepped up to the plate and distributed a lot of money to cities to get them out of the pandemic mess. And those funds are generally not repayable and generally usable through the end of 2022. So, for example, say Chicago, that's about $2 billion, fills their budget deficit next year, probably or this year, and probably next year as well. They don't need to change any of their spending or management behaviors. They're fine if they choose not to, because it's funded. I would wager that in 2023, the gravy train ends, at which point a lot of primary markets and secondary markets, to be sure, but a lot of primary markets will wrestle with, oh boy, I've got a big gaping budget hole. My credit rating was not so good before, but now it matters. It's getting worse, and I need to cut spending or raise taxes. And these big apartment and office buildings can't be moved. That might be a good place to raise additional tax revenue. So, or even residential homes. So that could be a double whammy where people move out and the taxes go up. And I think it applies a little bit more to the darling primary markets of the last decade than it applies to the markets that we're all debating on this panel. I'll just throw that out for the other panelists and the audience to react to.
Yeah, any thoughts on that, Jeff, Joseph?
Yeah, I mean, I think it's a good point, and another driver, along the lines of affordability is, you're seeing from New York, for example, a lot of, wealth managers, financial firms moving down to Florida, just fleeing, the high taxes, tax burden, et cetera. So, I certainly think that plays a role. And I agree with the comment that near term, some of the more gateway cities are going to struggle, but I also agree with another comment that, they're not dead. The major urban cores have survived, pandemics before. And I think it just comes back to what we were talking about in terms of stages of life. So millennials are getting to that point, and, for us, we're trying to invest in front of that wave, that large demographic. But Gen Z, the older Gen Z folks are just starting to enter the rental market. And at the end of the day, at that stage in your career, you still want access to those amenities. We're social creatures. We want to be collaborating, and from a career advancement, being in front of people, learning. So that generation where, again, you're maybe early in your career, not necessarily making the same kind of incomes and not as sensitive to some of those tax burdens, et cetera. You're still going to there'll still be interest in the urban gateway markets. I don't think the Sun Belt secondary market strategy and any kind of gateway are mutually exclusive. But you kind of look again at the growth stats that Hans put up, and I just look at where Austin was 20 years ago, Denver 20 years, even nationally. Trying to find those markets, they're just going to have outsized growth profiles versus a New York, a Los Angeles, or San Francisco, just where they are in the maturity stage of the city. I mean, speedboat's going to go faster than a cruise ship. It's just that simple.
That's a very good point. And some of you have already heard me talk about this, and I apologize for repeating myself here, but I have my own personal example in my own family. My little brother, he and his wife could not afford a place in Bushwick in Brooklyn. They were being priced out. So where did they go? They bought a house in Marietta, Georgia. Okay. And they're fine because it's a community that they want to be in. It's younger people like themselves. And they're very happy with it. But that's the kind of thing that's happening. And I see that in so many places. For us, again, we look at it, and just on the senior living side, we think that these again, you're going to have 74 million people in the Gen Z demographic, if I'm not mistaken. They got to go someplace, and they're looking for this whole idea of community and being able to see and work with others, talk to them, whatever, and raise their families, and then move into the later part and stages of life. That's a huge group that has to be dealt with. And it makes sense, for us to do as much as we can in the multifamily area to give them, a place to be. If that makes any sense.
Yeah, sure.
Okay, well, Chase has been kicked out, so he's having some trouble getting logged back in. So I'm going to have to kind of take his role up a little bit. And I'm looking for some guidance from him right now. So he says we're at closing comments. So it's time to kind of bring this to a close, give each of you a chance to make some final comments. I'll let Hans go first, then Joseph, and then Jeff will close it out. So Hans, just a few thoughts.
Jeff, thanks very much. I think it's been a great panel so far. I look forward to hearing the next part. Overall, I think the next 10 years are going to be very different than the last 10 years. It's going to be defined more by secondary and tertiary markets. To Jeff's point, New York City and LA are not going away. I think they'll be even more important hubs of business and intellectual leadership 10 years from now. But I think the next 3 years really belongs to the markets we're talking about today. I'll leave it with that.
Okay.
I would tend to agree with Hans. I think the next 3 years are important. For example, I know that in September and October of this year, we're going to look at our next 3-year plan and see where we are. We decided we could ride through COVID, but we've got to look at again the future and the changing demographics. But we believe somewhere around 23, 24, 25, there'll be some changes, but we should be ready for them. We've got a good staff to work on it, and we'll just be around. We've been around for 300 years in one form or another. I think the next 3 will be okay.
Okay. Geoffrey, you get to close out for us.
Great, thank you again. Thank you, Jeff and Chase and fellow panelists. I think this has been great and hopefully educational for the audience. Look, I would just close with, post GFC, we drastically undersupplied housing. Multifamily, I would expand to call it rental housing, and it covers a whole variety of different housing types. As folks are moving, different stages of their life, they're going to need a different sort of housing profile. So we're focused again, following the trends where the millennials are one of the largest generations. Where are they going to move to? They've got more options now. As the landscape has changed in terms of how and where you can work from. They've got a lot more choices, and it's again identifying where are those next growth markets that are going to outperform, and just supply and demand is in multifamily's favor.
Yes.
All right, great. Thank you. Thank you, all of the panelists. Really appreciate your participation and input and all the prep that goes into getting ready to do these things. Hopefully you've all noticed listening in that it has been pretty free of marketing, which is characteristic of the programs that we try to produce. We really want to focus on the educational aspects of this. And I think both panels have done a terrific job in helping us all get some insights into what's going on in terms of the various sectors, where the opportunities lie, where the risks lie, and those sorts of issues, which are things that all investors have to take into consideration when they're figuring out where they want to concentrate and focus. But don't go away. We're not through. We're going to take a break, a 10-minute break, but we're going to come back and focus on our final panel, which is on the future of multifamily, technology, and sustainability across all markets. So we'll kind of pull it all together into one final session. So don't go away, take a break, but do come back and we'll get started in just a few minutes. Thanks.
So if I could ask my panelists to unmute themselves, we'll jump into part 3 of our 3-part webinar. And again, just to kind of provide kind of an overview, kind of the start of this was really kind of talking about kind of the macro level gateway to suburban. Second group really dug into suburban secondary a little bit more. With this group, we're going to probably get a little bit more micro, talking about sustainability, technology trends, things kind of at the asset level. So want to thank my panelists for part 3 for joining. Similar to the other groups, we're just going to start with name and organization and give some good background on kind of how you guys are positioned in the market, what you're doing, and then we'll go into the questions. And again, with the audience, I want to make sure to reiterate, you can type in questions now. We can kind of have it building as we're going through, and we'll address them as we go through. And again, to my fellow panelists, if you have questions of each other, obviously ask each other questions. So start things off. David, we'll start with you, and then we'll get going.
Okay. Thanks, Chase. Thanks for the invite. And so far, I've learned a lot. So I'm David Stanford out of Dallas. I'm with Real Foundations. We're a real estate focused management consultancy. Work with developers, builders, operators, and investors sort of across the real estate spectrum. And we work with a lot of multifamily, single family, rental, and home builders and the work that we do.
Perfect. And Randy?
Hi, my name is Randy Norton with Multi-Green Properties, and we founded this company about 2 years ago with the commitment to solely focus on ground-up construction of attainable, sustainable, and tech-enabled multifamily for rent housing. So I think the panel topic today is very relevant and near and dear to us. And we have committed to construct 40,000 units by 2030. And all of this will require a lot of ESG and tech enablement behind it.
Perfect. And Chris?
Thanks, Jace. Chris Losapio, principal with FCP. I run asset management for the firm. FCP was founded in 1999. We're a national investment platform in roughly 16 markets with a swarm to warm strategy. We invest primarily in value add multifamily, but also in Class A development, in equity, preferred equity, and mezzanine debt. We've owned 45,000 units over the course of the firm's 21 years. Currently, the portfolio is 16,000 units.
Perfect. Thank you. So jumping into some of the questions. So maybe start with you, David. You obviously kind of sit a little bit uniquely as far as the other panelists. So I mean, just kind of starting right off this, we're talking about sustainability, technology. I mean, from where you guys are sitting, I mean, what trends are you seeing when it comes to implementing technology? What's happening now? What do you see on the horizon, just kind of in general?
Okay. So let me go through sort of 6 points. The first is kind of the consumerization of the living business. I'm not going to say multifamily because I think it's broader than that now.
Yeah.
Digital engagement and choice of channels from consumers versus a real estate first focus. We've seen an explosion of that. The second thing is what we're seeing emerge as next generation platforms. Really a shout out is due to UDR in the REIT space. They've been one of the leaders, and we're seeing real proof in both from an implementation of technology deep inside the operations, both revenue and controllable expenses, but that's just not limited to tech. There's a lot of hard work that goes into that. but there's now proof and measurable basis point improvement on NOI margin and really NOI per FTE versus peer groups, largely around data-driven pricing, customer experience, and attendant satisfaction. Some improvement in days vacant, and then maintenance costs.
Okay.
And that's all being measured with much higher level of satisfaction, with the significant staffing efficiency. And I'll come back to that later because I think it impacts the operating models of especially third-party managers that many of the institutional folks hire. And then, you know, from an investor standpoint, this is all very difficult to do in a multiple manager scenario because you don't control everybody that works for your portfolio.
Mm-hmm.
And you know, it requires lots of questions and planning and suspicion. And then the final thing, back to the kind of the staffing efficiency, we're seeing third-party companies now start to pull back business functions and processes that were historically pushed to the site, so they would be reimbursed for that labor, to a more central model.
Mm-hmm.
However, that, you know, that's going to require some mind shift from investors on how that stuff is reimbursed, and that's a conversation that we're having with some investors now to have them rethink that reimbursement process.
Okay. Maybe jump to you, Chris. I mean, from where you're sitting, I mean, evaluating different technologies, different things like that. I mean, do you guys look at it kind of from using technology to cut costs, generate revenue? Is it a combination of both? Kind of how do you look at implementing? And again, I think for context, again, the first groups are talking about cap rates being low, yields. I mean, just it's a very hot market. So I mean, probably looking for kind of any tools possible to improve the assets. So
yeah, well, let me start out. Those were, I think, a great summary, David, of some of the trends that we're seeing. One other one that I'm seeing is just the general capital flows into prop tech. I sat through probably half a dozen different venture funds and heard their pitch. I think all of them were raising larger vehicles. Many of them were oversubscribed, and most of them had a material portion targeting generally residential, and multifamily being a component of that. So capital flows into prop tech, I think momentum continues to have a tailwind. And what that brings with it is obviously a slew of new investment in new companies. So when you're asking what we focus on, there is a lot of new startup prop tech companies out there, and you really have to sort through the pack. And the easiest way to do that is to categorize them into, is this a technology that is going to impact operations or kind of higher investment management? And then within operations, are we generating new revenue? Are we saving money? Is it a pure efficiency play or better quality of information? And we kind of look at that and say, how big is this opportunity? Because evaluating these new companies and technologies and having a culture of innovation does take resources. So you can't do them all, and you have to be able to triage quickly what is going to add real value.
mm-hmm.
Yeah, I think, Chris, on to pick up a point on that, especially in an investor situation where you have multiple managers, the conversation quickly becomes, who's going to pay for this, right? Who's going to pick it up? Is the consumer going to pick it up? Am I the management company going to pick it up? Or is it going to be passed through as an additional sort of a la carte to the investors? And having those conversations is starting to be pretty tricky.
Well,
David, I think that's a perfect segue to what we're doing. We've decided to pick that up. And at Multi-Green, our whole thesis was that we were technologists first and finance professionals second. And we spun out of the data center space and pivoted into the multifamily space to bring those technology efficiencies and energy management capabilities. We really view the multifamily space as data centers with people in it.
Interesting. Well, and I think one thing, even going back to Chris's point is, and maybe stay on you, Randy, to answer this, but kind of the segmenting of, I've referenced it before in our prep calls. It's like we did conferences 3 years ago, and it's like you got kind of futurists, and then you've got the asset management level technology, and you've got property. It's just kind of technology all being thrown at everyone, just from not really focusing on the function of it. It's more just broadly, hey, you should use technology. And I think that's one thing where we've kind of looked at is like, how is it broken down between kind of the functions? So, I mean, again, you're saying data centers with people in them. I mean, how do you kind of classify the different technologies that you can use to improve the operations, make it more sustainable? I mean, how are you guys classifying the technology aspect?
So for about 37 years, we did data centers and asset allocation into various funds as an LP, and we saw a lot of inefficiencies.
Okay.
And so we wanted to begin with the end in mind, Chase. And to do that, it's beyond property management, it's facility management and bringing those efficiencies. And to do that, you have to take ownership of the technology from end to end and really building out that digital infrastructure and the technology map that is interoperable and compatible. And that goes all the way back into the pre-design of these assets and pre-construction. If we were trying to standardize and normalize our portfolio, which we are, the only way to do it is to really think through the technology complications and have some integration there. So we really are focusing on a workforce plus initiative and increasing the digital amenities, not necessarily the physical amenities of the property. And we can expand on all that throughout this panel.
Yeah, well, and I think that's a good segue. Going back to you, Chris, I mean, kind of from the tenant perspective, from what you're seeing, I mean, just from tenants in general, whether it's better, something as simple as better internet service, services, things like what are you seeing, and factor in wellness? I mean, all those different things. I mean, what kind of things are you hearing from tenants that they're kind of demanding from a tech / sustainability / wellness perspective?
I think everything you just named certainly falls into that category. Faster internet speeds with work from home has become increasingly important. Really, convenience generally. I think technology, when we look at it, says what problem does this solve? And I think what residents are really looking for is convenience throughout many aspects of their life, whether it be package delivery or having to do with transportation, communication. 2019 was the year of the resident app. Every company was rolling out a resident app, it felt like. And how many apps do residents want to have on their phone for their apartment community? One, maybe two at most. And so I think we're going to see this trend of a couple of winners coming out of that bigger names that kind of get scale in that space, but they're going to serve that purpose, and they're going to bring that convenience to the resident where you have one-stop shop for a menu of services.
Well, and maybe go to all of you. I mean, or maybe go back to you, David, as far as the more technologically advanced, more convenient properties. I mean, and maybe it's too early to tell, but are we seeing those properties being sold at a premium? Are they basically garnering higher rents? I mean, again, you can talk about what we talked about earlier, gateway versus suburban, but I mean, getting down to the asset level as far as just wherever you are, whether you're suburban or gateway, I mean, what kind of premiums are you seeing when properties are being sold that you're trying to buy just a more technologically advanced property, or just demanding higher rents? I mean, is that something that starting to see yet, or is it still just too early to tell?
Well, it's probably a little bit too early to tell. We're not really on the back end transaction. However, I can do simple math. So as long as you can demonstrate positive NOI accretion, that's, that's opportunity there. We do see a number of our clients who are, going and underwriting portfolios that have been, undermanaged, or they're in a value add situation or something. They may be running at, the low 60s NOI margin.
Mhm.
And in some cases, you can underwrite quite a bit by impacting the staffing levels. And there are some rent increases with some of the technology for now. I'm
Mhm.
not sure that that's going to be always. And there's proof in the pudding. I mean, people who are interested can go out to UDR's website and look at all the stuff that they've talked about and they have delivered to the market. So at some point, though, it's going to be like air conditioning in the South and West.
Mhm.
It's like it's just table stakes. It's what's expected,
Mhm.
because all these consumers are being trained by Amazon, Airbnb, Uber, and even the student housing operators
Mhm.
to have and demand and expect a different experience. So we're not sure how that premium stays around versus the ability to transact. But
Mhm.
there's still quite a bit of lead time for that to happen.
Well, and maybe staying on that as far as transactions, because we got a question that came in that I think ties in with what you were saying. Because we've talked about resident experience again, being trained to want Amazon, that just the level of convenience people are demanding. I mean, could anyone want to jump on this one, talk about using prop tech / data when it comes to acquisitions or site selection? So not just, again, resident experience operating impacts, but kind of that acquisitions aspect.
Yeah, I can jump on that. I think
Okay.
a couple examples of that is using new new data that's available. Historically, retail has looked at mobile cellular device data to help with forecasting and site selection. We're starting to see that in multifamily as access to that data has become more affordable and more prevalent. You can really map domestic migration patterns in much closer to real time.
Mhm.
Secondly, I think with the advent of kind of these mega property management systems gobbling up market share, those data sets have become tremendous, and benchmarking and having transparency into very localized and standardized expense data, that's relatively a new phenomenon.
Mhm.
And then lastly, I think in terms of site selection, in terms of ESG, a good example is using predictive climate software. We have the FEMA flood maps. For those that don't know, they have very little predictive capability in terms of if your property will actually flood and how climate change will affect your property. There is a lot of new software out there that will model climate change over time and give you a risk score of your site. And really looking forward, I think that could become the market standard.
Interesting. Anything to add on that, Randy?
Yeah, before we created the company, we did some research and some Monte Carlo work in identifying the risk of where to identify, and pursue market opportunities. And we really selected everything west of the Mississippi, just going back to the earlier conversations today. We really looked at the CoStar data with level 3, 2, and 1 quality type apartments. And we really isolated what drives the demand for attainable apartments. And through some regression analysis and looking at various variables like cap rates, vacancy rates, natural vacancy rates, volatility, it really helped us isolate maybe 17 MSAs that we wanted to go forward in. And then for us, it's all about demographics, not necessarily location.
Mhm.
And someone earlier on the market said it's sub-market driven, and it's even further than that. It's neighborhood driven. So at some point, some of this becomes qualitative, and some different heuristics have to be used in your underwriting.
What about you, David? Anything from your perspective that you've seen?
Yeah, I think what Chris touched upon is the ability to sort of harness what used to be called unstructured data, excuse me, or contextual data, and co-locate that like next to your existing operational data, and then benchmark data. That has been just, largely the world of research, not operations. And it's been very hard to do in the past. And, that's one thing that we see there are a few emerging firms that can really help sort of catalog that and then put that to use on the investment decisioning process. So that's good. However, there's been, as Chris said, there's been a bunch of money plowed into this. $50 billion in the last 6 years, 8,300 and continuing to rise prop tech companies, plus a bunch of other stuff from sort of different industries that are now looking at real estate, which is interesting. But and all of that growth and foaminess, there's two areas, and for any of you entrepreneurial folks out there that are just complete voids. And we were just talking with a large investor last week about this at a big real estate tech conference. Budgeting and forecasting and renovation, kind of enabling technology, is still pretty much a wasteland. And it's something that budgeting and forecast is something everybody on this call does. And it's still pretty much driven by Excel and elbow grease and a bunch of phone calls and emails. And then the renovation process, we haven't quite sort of as an industry caught on to what home building has done in the last 15, 20 years with the sort of enablement of their supply chain and trade contractors. And there's opportunity out there for those two.
Well, I do think that brings up another point as far as I would assume, again, you guys are having probably tech firms, things like that come to you a lot. I mean, Chris, you referenced the pitches you've seen. I mean, how hard is it to sift through kind of the nice to have versus what's actually going to add value, help cut costs, find revenue? I mean, I feel like that's got to be, again, you've got so many guys out there that are going to change the world. Like, how do you sift through all those different things and make your decisions?
For us, it's, what problem is this solving?
Yeah.
If there's not an answer to that question, it's immediately probably not a high priority. If there's not a problem that it's solving, it's difficult to justify that there's going to be a lot of value being added, with some exceptions. When there's a real disruptor or something that just has massive potential, it's pretty easy to spot those. So that's kind of where we start. And then, typically what we'll do is pilot programs. We'll pilot the technology and then do a study of, proof of concept and what was delivered, what was promised. And then if it is, we roll it out to the remainder of the portfolio.
Okay. Well, and
yeah, Chase,
anyway,
one thing that we see is a lot of assumptions being made, because a lot of these prop tech things are very narrow, focused on one specific micro process in some cases. And there's a lot of assumptions made about the ability to integrate with the controlling the technology that controls the resident or controls the unit.
Mhm.
And I think one of the things that we help people with is sort of evaluate, because some of the major players don't really like to play well with others.
Mhm.
So that's something that is really important, because it is very, very difficult for the average management company to integrate all of these pieces themselves. And so lots of questions and sort of diligence involved around how on earth are you going to get this integrated into my shop
Mhm.
without making me blow up my IT staff
Yeah.
and cause me lots of pain. That's a recurring theme that we see.
And
Basically
Chase-
the transition needs to be seamless versus, and again, you're probably never going to be seamless, but as seamless as possible versus just a nightmare. The other extreme.
I would just
It's
add to
pretty
that.
it's
Mhm.
pretty clunky.
Randy, what are you gonna say?
Phasing it.
Yeah.
We're on now multi-green 2.0, and we've really spent a lot of time in thinking through this and creating an ecosystem that makes everything interoperable,
Mhm.
because we know that all of these problems have to be eventually solved, whether it's 2 years, 4 years, or 10 years down the road. And we think that eventually, when we reprice these assets and potentially sell them or recapitalize them, at that point, I think we're going to see potentially some price premiums for whether or we're using measurement for technology to measure sustainability or efficiencies in the expense ratio that David was mentioning earlier.
Mhm.
But we're getting to the point where we believe we're almost a software company. We've got some software engineers in our data centers that are working really diligently to try to solve the issues of our specific niche, which
Mhm.
is ground up construction development.
Mhm. Well, and
Chase, one
Yeah.
one thing just for the audience in general, sort of a tip on kind of how to do this. There's been a lot of discussion about smart homes, smart apartments for really 15 years,
Mhm.
and a lot of sort of wind got at that back in the days of COVID, but it was coming before. There's still quite a bit of debate about it. There are some people that are way smarter than me that operate some big portfolios, and the singular value proposition for a smart home technology investment from a capital standpoint
Mhm.
was leak detection. So
Okay.
the avoidance of leaks and the avoidance of claims, and this is now the P&C companies know all about this,
Mhm.
paid for everything.
Mhm.
And then the benefit on top of that enablement, and we're going to get into ESG in a minute, enables all kinds of new measurement that was
Mhm.
never before possible, and then a completely different interaction with the consumer,
Mhm.
which was also dramatically accelerated in COVID. Because I remember back in October of 19, I was in a session where there was a big debate about whether self-showing would ever be a thing. And then 3 months later, there was this thing called COVID, and self-showing became a thing, whether it was tech enabled or not.
Yeah. Well, and that does bring up a good point as far as technologies that, again, that you look at what we're doing here. I mean, doing this. I mean, we've even
Yeah.
looked at from our business model. It's like, again, when the world goes back to normal, whatever that is. I mean, this will continue to probably be. We'll continue to do this as a complement. And I think one of the things we've heard is, as far as kind of the virtual touring, it's not going to completely replace virtual touring of a property, but be good to get your thoughts. But maybe that's how you narrow it down to the 2 or 3 you want to go take the time to visit versus visiting 20 over the course of 2 days. I mean, how much of it are you looking at it too much from wholesale technological change versus just adding some efficiencies? Is that a fair way to look at it,
But-
Randy?
I agree.
Okay.
I think it's an addition of a channel,
Yeah.
right? It's not the only way. It is a way, and like in home building world, I was listening to the CEO of Taylor Morrison on a podcast this morning, and they did this kind of reservation system, because you can make a reservation for dinner on Open Table, quite easy.
Mm-hmm.
Very, very hard for the real estate world to do that sort of prior to COVID, and the take up rate on that just blew them away. I mean, it was astounding.
Mm-hmm.
And the quality of that traffic there was much higher, and the conversion kind of ratio
Mm-hmm.
was much higher. So yeah, I think it's not either or, and it's also not going to be put back in the bottle.
Yeah.
I mean, that genie is out, it's escaped, it's long gone, and it's here to stay as another channel.
Yeah.
Chris, I'd be interested in kind of what you guys are seeing.
I was going to say, we saw, I mean, just looking at the actual hard data, we saw a massive shift kind of 60, 90 days into COVID of people not wanting to even schedule an appointment to physically come to the property, even though at that point we had reopened by appointment only. And I think we saw that persist. And if you looked at our leasing velocity being primarily concentrated in the Southeast, we had year over year increases in a lot of cases in terms of leasing and traffic, and our occupancy was actually slightly higher in the portfolio. And certainly people did start to come back and want to see apartments in person as they were leasing. But a good majority, I think, continued to be comfortable through several of the alternative channels that had been developed right at the start of COVID, whether it be as simple as photographs or a virtual reality experience of being able to actually walk through the unit. All of those things, those are going to continue to gain in momentum. And to your point, there always will be a small portion that want to come in person, but I think it will just reverse from the majority of people coming in person to now the vast majority will not, and some will.
Well, and just want to remind the audience, if you have questions, you can jump in, because David kind of teed it up talking about kind of the ESG perspective as well. And I mean, I think the way we look at it after talking to you guys, other groups, is there is a level of it's somewhat intertwined. Again, kind of the sustainability with technology, just look at kind of what you need to measure it as well. So I mean, with that, I mean, I want to kind of get Randy's thoughts, and again, reminding the audience that they can ask questions as well. So I mean, for you, Randy, so I mean, what are some of the metrics that you guys are looking at or plan to look at even down the line to monitor sustainability, and then why are those metrics important?
Measure those metrics. Many are qualitative, but the ones that are quantitative actually require data from the properties. And so this goes back into the technology conversation. And sometimes there's not technology today to track or measure some of the ESG requirements. And this is, again, Excel and elbow grease. But we are future-proofing these assets by really over-investing in the digital infrastructure, so that we can, put in sensors, and when the software and technology becomes available, or we know what we want to measure, we can do a better job of that. But we worked on this even before we launched the company, and there's 80 plus frameworks that our industry or the finance industry could pursue in trying to measure ESG. And I think there is an overarching umbrella that UNPRI and the SDGs provided. GRESB has done a fantastic job in being a pioneer in this space. All of our properties, for example, will either be Green Globes or a LEED certified building, just as a base fundamental. And that comes with its own checklists, filters, and reporting requirements. And now you're starting to see that as well with the health and wellness. And you can have really the International Well Building Institute or the Fit Well standards complement the work that you're already doing in the ESG front. So I think this is evolving. One thing that we've tried to do is also measure those ESG variables into what impact would be it would be having on our specific communities. So the two things that we're measuring are the internal rate of return and also the impact rate of return.
Okay. Interesting. Yeah, David, Chris, any kind of additional metrics, thoughts on that you're seeing?
I mean, I would just add in terms of how ESG and technology are intertwined, I think you can really break it down into 4 column ingredients for a recipe of ESG improvement. First, there has to be the willingness to prioritize ESG period. Secondly, you have to have the resources to execute on improving ESG, government and stakeholder support, and technology. All 4 of those things working together. So it's one piece of the puzzle in terms of having a successful ESG policy and execution as part of your strategy.
And David, I know you're going to have some comments on this, but Chris, to your point, the reason why most people don't do this is because it's cost prohibitive. We're going to be into this millions of dollars before we even make a penny. And that had to be a very intentional decision. And we now have to be looking at a longer time horizon, 10 years and beyond. Of course, our favorite hold period is forever, but that's not realistic. And without having that long-term perspective, nobody's going to, incorporate these strategies.
That's right.
So as a manager that's just starting, we're going on our 2nd year, we not having any legacy assets beforehand and having a modicum of capitalization, we were able to do that initiative. But man, looking back at it, be careful what you wish for, because it's a Pandora's box.
Yeah. Well, remember, leak detection enables ESG data collection, right? And from an investor standpoint, because we're very familiar with the LPs push mandates down to the GPs, push mandates down the JV partner, and stuff rolls downhill. But the ability to really measure, monitor, and then fine tune the performance, because you wouldn't do it otherwise, especially on the E side, that is going to require enabling technology at the home. And somebody's got to pay for that from a CapEx standpoint, and it's going to factor into the buy side decision the next time that asset trades. And that's, we hear a lot of like whining and complaining from management companies. We keep just getting asked and asked and asked and asked. Is like, well, somebody has to produce the capital. So those are tricky conversations to have.
I would just say one more thing. In an earlier panel, they were mentioning that water, I think it was Dodge or Mike, water is being the next issue. I'm here in Las Vegas, and NV Energy is telling us, when to turn our power on. City of Henderson is telling us when we can use water. And I think that ULI has done a very good job with their Green Print initiative to really focus on net zero. And maybe a year or 2 ago, I rolled my eyes. And now I really want to champion that initiative entirely, seeing it firsthand here in my neighborhood.
Well, and I mean, how would you say, going back to, like you're saying, go for the LP to GP to operating partner, kind of that, I mean, how much can you, maybe this is even a segue also to kind of some closing arguments, not arguments, but thoughts. I mean, how can you put pressure on, say, the construction team, architect, that, again, I mean, if you're talking about whether it's value add or things like that, that can add genuine value at that level. I I mean, how can that pressure go down? I mean,
I have a comment on that, Chase.
yeah.
So,
Absolutely.
And then maybe start with your kind of you can start with the kind of your final thoughts as well. So
this is why we created Multi-Green. We couldn't find anybody
Yeah.
doing it. As an LP, we had no say. There
Mhm.
was highly inefficient operations. There was no technology integrations. And we said, you know what? We're just going to go do this ourselves then. And we got about 60 families, some of the leading families of the world to back it. And now we're still struggling to implement it. But that being said, that is the $1 million question. And I think that from a leadership perspective, it needs to be required.
Mhm.
So as now a GP, or even that of the pre-design process, it absolutely is an owner program requirement. It's a design guideline requirement.
Mhm.
And this becomes where the tech really gets fun. There's more efficiencies, there's more scalability, and you can say, hey, it might have cost us $1 million to do on this first property, but the next property, it's only going to cost us a couple $100,000 because we've already got all the know-how and the R&D figured out. So that's what we're starting to see. There's a total J curve here in the efficiencies of technology and ESG reporting.
Well, and I think one thing, again, just real quick on that subject, I mean, you look at from a human level, I mean, again, you talk about technology in general. I mean, I'm sure you have the feelings, whether it's construction, design, of this is going to replace me.
Well, one more comment. Bruce Greenwald wrote a really great book on that, by the way, Competition Demystified. Ashby Monk wrote a really great book as well to contradict some of that argument, which was The Technologized Investor, which is a spin-off of The Intelligent Investor. And maybe it's time that as managers, we reinvest in the technologies ourselves. But I will say this, because we're writing the checks, the general contractors and the subcontractors and the property managers are starting to listen.
Capital rules. Right.
Well, and yeah, maybe just
One last
think-
comment, Chris.
I think
one last
one
comment.
thing-
Dave, one last comment, and then I'll
Yeah.
be done for the day.
Okay.
There's a reason why we're doing this, and that's because we
Sure.
make money at it. People think that this is a lost cause or a wasted expense. It's not. This is more efficient and more profitable in the long run. You just have to hold the property longer.
Yeah.
Go ahead.
Well, and then
I
I'll
think
get
there's work to do because there's been so much focus in our industry on the E of ESG that the S, and Randy and his group are trying to make a big impact on this, but it's still small in the greater sense of the affordability gap, which is a global thing, but how you impact communities, how you measure that, that's still pretty murky. The other thing is the supply chain, measuring the impact of ESG and kind of equity in the supply chain. There's something that the roundtable is starting to talk about, the real estate industry roundtable on the measurement of the supply chain. It's really hard to do. Back to all the frameworks, there's lots of ways that that is measured, but none consistently. And I think that's a responsibility that we have as an industry, and to focus a little bit more on the S than the E.
And Chris, kind of your closing comments.
I was going to add that the G has to come along as well. And it sounds like a lot of what we're talking about has to do with the governance and starting out with having written policies, responsible contractor policies, sustainability checklists that go along with every single acquisition, and starting with something, because that creates a foundation to then grow on. And when doing business with JV partners or contractors, being upfront and sharing those documents and working through them, and getting to a better place. And then the market's going to dictate. If contractors say we can't work with your responsible contractor policy, there will be some middle ground that ultimately gets come to, but that conversation has to happen, and that falls under the G.
Yeah, and Chris, we're starting to see the incentives actually work, where bonuses they want are linked or directly tied to some of this performance or reporting. And so that's starting to help.
Yeah, that's a good point.
I would also say, Chase, it takes people with significant balance sheets. Oftentimes you have to work with the better general contractors and the better subs to get this kind of work done.
Mm-hmm. Well, and again, we're coming up at the end of this, so I wanted to just close with obviously saying thank you to you guys for joining. Again, all three segments of this have been incredibly valuable. Multifamily has been something really kind of leading the way the last year, or even longer than that, I guess you could argue. But again, to get down to the micro level, and I think one of the things we talked about before, just in prepping for this, is, I mean, some of the just simple things that it's not like you need to have kind of the Google Glass visualization futurist mindset. I think sometimes you hear technology like that's what you go to, but where it kind of overlaps, we talked about ESG, and it was for, I can remember early 2000s, 90s, it was talking about just from the idea of purely saving the environment. It's like you can't really get JV partners to make moves with that. It's just too down the line. It's about making money. But once it was, oh, lower your water bill, no flow toilets. It's like, oh, well, yeah, no, obviously I'll do that. So it's just like that kind of the shift in presenting some of these things, I think is critical, whether it's technology or ESG. It's just presenting it more simplistically than you got to be a futurist or you got to be out to do a huge lift. So
just start somewhere.
Exactly. So again, want to thank you guys for joining. Thank all the panelists. Bring in John and Jeff, kind of just your closing comments. And again, want to thank everybody. Thank the audience for joining. And this has been exciting. Thank you.
Thank you, Chase.
Thank you, Chase.
Thanks, Chase.
Jeff?
So just to close out, when I opened up, I said that it wasn't all that long ago, though it was certainly over 35 years ago, that people were questioning whether or not they really should be investing in multifamily or housing of any kind. And, nothing with beds in it was what people would say. And so we really have come a tremendously long way. But what's really interesting, if you look at the way the dialogue, the discussions about multifamily have evolved over time, it's become infinitely more complex, infinitely more sophisticated. There's so many more different things you have to think about today in order to be able to find the right kind of opportunities, to source the right kind of deals, to win the bids, to know how to price, to underwrite, to know what is going to attract tenants and what kind of amenities tenants need and what kind of services they need. It's kind of interesting to think about the digital component of all of this and how that's impacting things over time. And it's interesting for me personally, because, for the past, 45 years, I've been a homeowner. And now, while I'm waiting for my new condominium to be built here in Pompano Beach, Florida, I'm a renter again. And now I'm subject to property management.
Mm-hmm.
And it's been interesting. We've had a turnover of property management since we've been here, and there's been quite a big difference in the way in which communications to tenants are given. Prior communications were much more collegial, and the newer communications, while they're basically saying the same things, are much more dictatorial, much more top-down, much more me management, me owner, you tenant, you do things. So it's really interesting. People forget there's a soft side of this business that's really important for people who are owners and managers to pay attention to. Because ultimately what it comes down to in any service business, we've said this so many times before, it comes down to the experience of doing business with you. And a lot of times people move not because of the amenities, although those are attractive, but they also move because of the way in which they're treated from the very beginning and how they can expect the relationship to be with their landlord over time. So anyway, found the discussion today illuminating, learned a few things, thought about things a little differently than I was thinking about them before. I thought some of the things that you guys talked about were eye-opening. Some of the things that earlier panels were talking about in terms of, climate change, pandemics, things of that nature, was a different viewpoint and look into things than I thought about before. So I found it really helpful. Thanks to all of you who stuck with us and stayed through the end. And I think those of you that didn't, even though you're not listening, missed out on a lot of good content. So hopefully, if you did tune out and you do tune back in, go back over the recordings, because we will be sending out recordings to all the participants, along with a list of all the participant names and their company affiliations and what have you, and also Hans's slides. So all of that will be coming to you, so you'll be able to get some greater value from having sat and listened in. So thanks, everybody.
And just to confirm, we're sending it to all attendees as far as participants, that they'll have access, because I've got a few private messages that they're going to be getting access to the full presentation.
Yeah, well, I think it's also the registrants. Some
Okay.
people register but don't attend, but then they'll come back and look at the recording later. So for those that weren't able to actually log in, that doesn't mean they won't be able to get access. But if you didn't register, you're out. You don't get access to the information.
Okay. All right.
So in the future, for some of you, if you can't make an event, but you want to participate later by viewing the event and the materials, register. Even if you can't make it live, you'll be able to pick it up later. Okay. Thanks, everybody. Thanks for tuning in. We really enjoyed having you today, and hope you got as much out of the program as I did. It was really educational and useful. Thanks.
Perfect.
And thanks again to participants and sponsors. And thank you.
Everybody.
Thank you.
Thank you.